Hello everyone, so today I'm going to show you how we can use Google Finance function and Google Sheet for portfolio backtesting. Now, to do this whole analysis, what you need is just a Gmail account, because with Gmail account you will get Google Sheets, and with Google Sheets you'll be able to perform this type of analysis. Now, what portfolio backtesting is basically is you just want to check that if you had put $1,000 a few years ago in a particular portfolio, how it would have performed through the year, through the years. Now, uh, so first I'm going to explain what this Google function is. If you have never used this function, then it's a really simple function, and this is how it works. So it's equal to Google Finance, and then you mention ticker, and then you get price. That's it. So for Disney, today, for the price of the Disney is 115, and I'm just going to show you what the day is today. So today is 13th June 2020, and today is Saturday, so this is polling yesterday's close date, and this is the exact price of Disney stock yesterday. Now, you can mention any other ticker here and it will give you price. Now, since price is basic attribute which is default, you can pass down many other attributes and it would work similarly. So you can pass down volume, you can pass down beta, or any other attributes, just to see what other attributes you can pass down to Google Finance. All right, so these are some of the other attributes that you can pass, right? So price, open, high, low, volume, market cap, etc, etc. Now, and it's all up to you what attributes you want and how you want to use them in your analysis, right? Okay, so going back to our portfolio backtesting. All right, so I have basically two portfolios. So my second portfolio is rather simple. It's just SPY. I'm putting $1,000 there, and I basically want to use this as a benchmark that how my particular portfolio would have performed against standard SPY, right? I want to see, like, does my portfolio make sense? Is it worth to take risk? Is the reward bigger than putting my money in SPY? If reward is bigger, is it worth to take this risk? So I'm going to think about this type of things, but then first what I need to do is I need to do a back testing. All right, let's see. So my portfolio here it has three components: UPRO, UBT, and zeros. Now you may have heard of classic stock bond portfolios. It's usually 60% stocks, 40% bonds, or 60% bond, 40% stocks, or 50-50, or based on like what type of risk you want to take. Now this is a variation of that. What I have created here is a little more risky portfolio compared to classic stock bond portfolio, because classic stock bond portfolio usually gives 6 to 8, 7, 10% return. But then what if you want to check that if you take higher risk, then if you are is it giving you like better reward? And to check that, I'm using this particular portfolio. Okay, now how this is different than classic stock bond portfolio. So this tracks stock, this tax treasury, and this also checks treasury. Now, so overall basically my 66% money is in treasury bonds, and 34% money is in stock. But then if you don't know what UPRO is, let me just give you a explanation. UPRO basically tracks 3 times. So this returns 3x. It gives 3x returns of underlying benchmark, and underlying benchmark is SPY. So these moves basically 3 times for a given day for SPY. So basically in one sentence, if SPY goes up 1%, then UPRO goes up 3%, and if SPY goes down 1%, UPRO goes down 3%. That's it. And this is for a given day, not for a range, because it numbers would be different if you check for a week or for month or something. So this is a daily performance leveraged ETF. Similarly, what UBT is a 2x of daily performance of 20 plus year bond index. So similarly, this underlying US Treasury bond goes up 1 time, UBT goes up 1%. If Treasury goes down 1%, UBT goes down 2%. So this is again also a leveraged ETF. Then the third is ZROZ. So that's a 25 plus year zero coupon US Treasury ETF. Now this is not a leveraged ETF. This is just a single non-leveraged ETF, and I took one non-leveraged ETF. I put 33% of my money in non-leveraged treasury ETF to give this whole model a little stability. You can I also checked putting my money 30% in UPRO and 50% in UPRO and UBT, and I can show you how that portfolio work out in next video or something. But so today I'm going to check that what if I have $1,000 and I have these two portfolios. I can either do no thinking and put my $1,000 in SPY, thinking that in a long term stocks goes up and I'll make some money, or I can try this variation, which is 34% UPRO, which is 3x of SPY, 33% UBT, which is 2x of treasury bond, and zeros, which is 1x of treasury bond. All right, so I want to check what's better. All right, so this is how you do it. You just write down big letters, UPRO, UBT, zeros. You can use kind of like same template, or you want this file, I can share it too. Just let me know. All right, so this is very simple. You just need to write this one line of code, and then you are all set. You get all the data. So you write this one line of code for UPRO, UBT, and zeros, and then you're done. All right, so what the code is, it says E6. Now the first the first argument is name of the ticker, so here name of my ticker is E6, which is, oh yeah, it's here, E6. So it takes UPRO. What I want is I just want price, and this is timeline. So today minus 1,000 to today minus 1. So basically what I want is roughly last 1,000 days data. You can take more or less or whatever. I don't know what the right time frame is to analyze. You can run this model for different time frames and see how this works out. Maybe like last 1 month, 3 months, 6 months, or if you really want to test this, how this will work out in a long time, then maybe 5 years or 8 years, whatever, right? But then the whole point here is you can mention data range here. So I'm taking last 1,000 days, and if you just write that, then you get everything. You just need to write this whole one thing, and then press a tab, and you get all the data. You get all the data for UPRO. Similarly, I come here, H6, which is UBT, same, I want price, same time range. Here for zeros, same time range, SPY, and 6 price, and last 1,000 days same price range. All right, so now I have price of I have price, per day. This was the price, this day price, day price. All right, now this where I mentioned that this is my portfolio. So I have like overall $1,000. I put 340 here, 330, 330 here, 330 here, and 1,000 here. All right, so this checks, this is quantity, so with 300 for $340, with $340 on this particular day, when I start investing with this price, I can get this many stocks, right? So this is basically B4, which is the money I have, divided by F8, which is price on that day. So with $340 I get 8.89 stocks of UPRO. With $330 I get 4 stocks of UBTN. I get, for with same amount 330, I get 2.788 of stocks of zeros. Now this is fractional, but then this is basically an analysis, so you can buy like approximate number of stocks, or Robinhood and other also offers fractional shares, so it doesn't matter, like basically with $1,000 you get these many stocks, which represents this distribution. All right, again, you can use the same sheet to do every analysis just by changing some of the formulas. All right, same thing for SPY, 250. So very simple, I get roughly 4 stocks of SPY on this date, 18th September 2017. Now I here is where you calculate value, and next you calculate percentage return. So here what I'm doing here is C4, calculating value, which is basically I've got here quantities, right? So I'm multiplying basically these quantities to every day's price, right? So that's why I've kept these here. I have kept these fixed number C4 because this is quantity and this is F8. So if you go down, right, then this quantity stays the same. Price, I pick price from column F. Column F is daily price, right? So basically this is price into quantity. Quantity stays the same, price changes. That's it. So that's your value. Now this is value of all my individual stocks, and sum of that would be my total portfolio value 1. Similarly, for portfolio 2, it's just 1 stock, so I don't need to do this kind of like some stuff, right? Now every day I calculate value of individual stocks. I do a sum of that, and that's my total portfolio value. So as column S plus T plus U is here my portfolio value, and now since I have value of my portfolio, I check its performance, and to keep this simple, I'm calculating performance from the beginning of my investment. So that's from here. All right. So to check performance, basically what I'm doing is, since I invested $1,000, I've kept that, I hard coded this part, but then otherwise you can put this into a cell value and then reference that to here. But basically current value minus in the amount that I invested in initially, divided by that same amount that I invested individually, to check like compared to my initial investment, what's my return, right? So on the first day it should be 0 because the value is 0, and then if you just drag this whole thing down, same thing here, down here, right? Okay, so we are seeing here, right, like okay, on the first day my portfolio minus 0.1, then next minus 0.07, minus 0.06, and SPY is doing better, it's going up, it's going up. That's great, great, great. All right, so this is how you see, right? Like every day, these how these two portfolios have been performing, right? And so I did calculated this for everything, right? And then I created this chart to visualize, because it's, it's easier to see, it's easier to analyze or visualized information than numbers. All right, so my portfolio one, which is this stock bond combination, portfolio two is just SPY, right? So you can see portfolio 2 has been performing better for like a year or so, maybe more, yeah, more than a year, right? Like 1.5 year or something. And then somewhere around June 2019, my portfolio takes over and it just does starts doing really well, right? So here you can see at some point it has like 55% return, pretty good, right? And at the same point this had like around 34. And then here when the market was, this is the 20th March, where market went really down, this coronavirus crash happened. So you can see that this SPY, right, this line zero, and it actually went into negative, right? All your profits that you had earned up to this point were wiped out like just within a month, right? Because it's just a stock portfolio, it has 100% stocks. But on the other end, right, for this type of scenario, now my portfolio one, it performs significantly better, right? It doesn't go below zero. And even though this is where the crash happened, and this is like after crash, right? So if you see like on the 25th March, this my portfolio one gives you around 22-23% return, but that is because of these two guys, right? This would have gone down like really really bad. These $40 would be like zero or something, right? But then here, since these two guys are bond, and bond doesn't crash when this crash happens, so this kind of like, gives resistance to my portfolio. And overall, when 10th June, I'm still left with around like 42% return in this, like, what, last 2017, so roughly 2.5 year, maybe a little more than that. But yeah, you can see here, so basically 6 months of 22, and 3 months of 27, and 28 and 29. So this is like more than 2 years, right? So more during like this period, my portfolio is given like around 42% return, and the SPY has given 27% return. Now let's see like individually what exactly happened when the crash happened, right? So first let's see these big crash days, right? So this is when the market was doing like really well. This portfolio is doing like 54% return, 51% return, and then it starts going down, going down, going down. And this is when like the huge big crash days, and you can see these whole profits of last 2 years are wiped down. It was like 25%, and from that within a few days you go like -10. So with this portfolio, it's really important to have stop orders. You really need to know when to get out of the market. If you don't get out of the market up to this point, then portfolio goes down. And what if you decide that you don't want to lose more money, and you get out here, but then after a few days market gets better to 11%? So you really need to be really smart about when to get out of the market if you have just a stock portfolio. Now on the other end, this portfolio does perform, I feel it performs better around this time. Like outsleep well if I have this portfolio compared to this. If crash happens, since my 66% money is in bonds, I think I'll be able to sleep well. I don't know about you guys. So here, sleeping well because my portfolio is positive. I don't need to think about taking my money out. And even though it goes from 51% to 8%, 7%, it doesn't go negative, even though big market crash happens, right? Even though it is like one of the biggest after 2008 or 9, and still it doesn't go down. So it does well, I think, around this time. And when market picks up, I'm again back with 30-40%. So I think it also has like a better recovery. Why it has better recovery? Because upro is 2x. Upro is like a 3x of SPY. So SPY goes up, this goes up 3 times. So this has like a better and faster recovery. Now this is the latest data. If I had invested $1,000 in this portfolio on September sometime, I would have had around 37% return. All right, so again, I'm just mentioning this point that this is no way of any like suggestion or recommendation that you should do something like this. The whole point of creating this video is to how to use Google Finance and this tool or Google Sheet to do this type of portfolio backtesting analysis. And if you don't want to do this sort of create this sort of funky portfolios, just do something nice and easy, right? Johnson and Johnson, Microsoft, Apple, Google, Visa, create your portfolio and check it against some of the standard ETFs, right? Like check your portfolio against QQQ or against SPY or Vanguard's standard ETF and see how it performs. Check this kind of data points where market goes really up, market goes really down, and see how your portfolio performs compared to that. Now since this is also very basic, I don't know other formulas to create other ratios or variance and that sort of things. So this is like very basic price related analysis, and I hope you enjoyed this video. If you want to see some of my other analysis, then let me know. I'll share. I have like this TQQ TMF analysis, I have UPro TMF analysis, and I also like this comparison of TQQ TMF, UPro TMF, UPro UBT zeros, and then some of the opinion that I built and that sort of stuff. So let me know if you want to see more this type of videos. Thanks.